We've seen an upsurge in the use of speed in trading in financial markets. Basically, 2012 seems now, from where we're standing, as some sort of entry point. Since 2012, we've seen an increased use of microwave networks. Prior to that, we're seeing use of fiber optic cables to connect the distance between different markets, different platforms, because the reality now is that a stock or any instrument for that matter is not trading on just one platform. It's trading on multiple platforms at a time. So this is one of the consequences of computerized trading, market fragmentation. So this fragmentation creates opportunities for arbitrage. Basically, you can see price on one location and try to take advantage of that price change in another location. So because of that, we're seeing increased use of speed, and fiber optics is no longer enough for connecting the markets within Europe, because every single person that is fast right now wants to be faster. So want to be able to keep want to open some sort of speed differential. And those that are faster right now don't want to close that gap. They want to ensure that they retain their speed differential as well. So we have moved into this situation where we're leaving fiber optics behind. We're now using microwave technology predominantly for transmitting messages across markets. It's actually not halfway. It's closer to London than to Frankfurt, but it's well positioned in the sense that it is in a straight line pretty much between Frankfurt and London. And knowing that microwave networks travel in straight line, and you have to take into consideration the curvature of the Earth in setting up masts along the way to ensure that the network can relay a wave to one mast, and that mast can relay a wave to another mast until it gets to its location. So this village in Belgium on the border with France, Houstoun, happens to be right on the straight line, and it also happens to have a disused NATO base, NATO installation that has a 238-meter mast that is perfect for use with microwave networks. So you see high-frequency trading companies struggling to get access to that, to buy it off at an auction. And so, yes. Basically, what we see now in the literature, in the academic literature, and also when you're talking to practitioners as well as regulators, you get this sense that there is inconsistency in the way people view high-frequency trading and in the results that we're obtaining in the academic literature regarding whether it's beneficial for markets or it is not advantageous for markets. So what we've done in our recent research is to try to explain why people are getting different results. So we think that the reason why people are getting different results is because there are different types of latency arbitrage opportunities that high-frequency traders take advantage of. So when those arbitrage opportunities are toxic in nature, that is, they are driven by information, then it may benefit the market in some way, but it also impacts liquidity in the market negatively, which is not good for the market. But if it is non-toxic, overwhelmingly the benefit is positive for the market because it enhances liquidity in the market. It's complex trying to disentangle the effects of high-frequency trading on market quality characteristics. It depends. I'm sorry, there is no definitive takeaway other than the fact that it all depends on the conditions in the market. And what is true for one market may not be true for the other one. What we do hope, though, is that if regulation tries to come in and do anything, they should try to put in policies that will encourage faster market makers, those you could refer to as the good guys because they are the ones who supply liquidity in the market, than encouraging faster arbitrageurs, those who take advantage of liquidity that is being created by the liquidity providers.